Buffett's final warning. Is a stock market collapse looming? The collapse of the stock market in the next decade is imminent. If you don't pay attention now, won't matter if you look at it later, because this is the last and most important time Buffett has written to us. When someone is nearing the end of their life, their words often carry sincerity. Don't you find it strange? This 95-year-old man is unusually serious this time, and even warns that if we continue to act foolishly with finances, the value of the dollar will evaporate. As a result, many people immediately dive into analysis, suggesting that even Buffett feels the dollar will become worthless. Yet, at the same time, they show you this chart to say that Buffett is currently holding the largest amount of cash in history. Isn't that contradictory? If you truly believed the dollar would turn into scraps of paper, would you sell your house, stocks, car, or even your handbag to convert everything into cash? Wouldn't that be foolish? For an ordinary person, if they believed the dollar was about to lose value, they'd logically rush to exchange it for another currency, or buy safe assets like gold. But the reality is, Buffett has actually done just that. So, is he overly patriotic, lying, or, as he claims, holding this massive cash reserve for his successor to deploy in grand strategies, or have most people completely misunderstood him? I'll tell you this. There's no contradiction here. This will be the greatest plan of this century. Many say investing carries risks, but in Buffett's strategy, you'll realize that for those with vision, investing is never risky. What do I mean? Welcome, ladies and gentlemen. In reality, the chart most people are looking at doesn't mean much. You say Buffett is holding the largest cash pile in history, but ask yourself, has there ever been a year when he didn't hold the largest cash pile in his own history? If you look closely, you'll see that every year the amount of cash Buffett holds exceeds the previous year. It's simple. If you had nothing before, but last year you invested successfully and earned $1 million, you'd be holding the most cash in your personal history. If this year you earn another $3 million, wouldn't your cash holdings again hit a new record? This only proves that Buffett keeps making more and more money. Moreover, 20 years ago, having $1 million made you a millionaire. But now, is $1 million still a lot? Buying a house already costs millions, as the benchmark for being a millionaire has shifted to being a billionaire. It's natural that Buffett's cash holdings keep growing. So the real chart worth looking at is this one. The ratio of cash to Buffett's total assets. If I sell assets to get cash, my cash to total assets ratio increases, and the blue line on the chart goes up. Conversely, if I buy assets, the blue line goes down. Suppose you have $1 million and hold $10,000 in cash. Your cash ratio is just 1%. But if you have $20,000 and hold $10,000 in cash, the ratio becomes 50%. Therefore, what we really need to examine is whether Buffett is buying or selling assets. This is clearly shown in the chart, and you'll understand why Buffett is called the Oracle of Omaha. For example, in 2005, do you see how Buffett's cash ratio was higher than before? Then what happened? The 2008 financial crisis. By 2008, his cash ratio dropped to its lowest level. In other words, Buffett started selling assets and accumulating cash 3 years before the financial crisis hit. When his cash ratio hit its lowest, it showed he used that cash to buy assets at bargain prices during the market bottom. The period when Buffett made the most money was when he bought at the 2008 trough. Fast forward to 2020, when the U.S. stock market crashed again. A similar situation unfolded. A few years earlier, Buffett had gradually sold assets, causing his cash ratio to rise steadily. When the market hit bottom in 2020, his cash ratio dropped to its lowest again, meaning he used cash to buy assets at rock bottom prices. By 2023, as the market recovered, his cash ratio began rising again. Now it's at a level comparable to 2005. So we can reasonably speculate that when Buffett says he's leaving this massive cash pile for his successor, it might mean an opportunity to buy at the bottom, like in 2008, is approaching. If you can draw this conclusion, you don't need to worry about what Buffett is doing. Just keep investing in stocks. In 2001, Buffett missed the tech stock boom. Last year, he also skipped AI stocks. If this time follows the 2008 playbook, will Buffett wait for the market to bottom out before buying again? If you believe Buffett has spent his life proving that those who go against him end up worse off, then perhaps just reading this letter of his is enough. His past letters can now only be studied from a historical perspective, but this final letter might be his last reminder of a 2008-like buying opportunity. In reality, one successful bottom buying moment in our lifetime is enough to multiply our wealth many times over. If you don't want to be a victim of this economic upheaval, or even want to seize the chance to climb to a higher economic class, subscribe to my channel. I'll provide more useful insights in the near future. If you're worried you'll forget this content after watching and waste your time like this video, it'll automatically save to your playlist so you can revisit it anytime and act accordingly. Why does Buffett warn that the dollar could become worthless, yet still sell assets for cash? There's no contradiction here. Seriously speaking, Buffett isn't really holding dollars. He's mainly holding short-term U.S. Treasury bonds. These bonds, with maturities of 3 months to 1 year, can be sold any time to convert into cash. Essentially, short-term bonds are considered cash-like assets. Think of it this way. Water and ice seem similar, but are fundamentally different. Cash is like water, while short-term treasury bonds are like ice. When needed, ice melts into water. So what Buffett holds is a massive cash pile, and dollars are just a part of it. Beyond that, he holds a huge amount of short-term U.S. Treasury bonds. As we mentioned earlier, when the U.S. raised interest rates, Buffett sold stocks and used the dollars to lend to the U.S. government at high interest rates. In essence, what he holds is high-interest IOUs that the government must repay. The issue is that fewer people want to buy long-term U.S. bonds, 10 or 20 years these days, causing their value to plummet in recent years. When the government runs out of money and can't borrow long-term, it has to borrow short-term from big investors like Buffett at high rates. Buffett lends to the government, but he doesn't accept 10 or 20-year loans, only 3 months, 6 months, or at most 1 year, at rates up to 5%. For more details, check my video from last week. This is Buffett's first strategy, lending at high interest rates, but reclaiming the money quickly. So, what's his next move? Issuing a warning that the dollar's value could erode. Many people only hear the second half of this statement and jump to the wrong conclusion, ignoring the first half. It's like if I said, if you eat too many sweets, your teeth will decay. The point isn't that your teeth will definitely decay. It's a warning not to overindulge. Similarly, when Buffett says the dollar could become worthless, he's not saying it will happen. He's warning the U.S. government that if its financial policies remain misguided, the dollar's value will evaporate. In other words, he's urging the government to act now. So, how does Buffett want the government to act? Just look at the aftermath of his letter's release. The U.S. stock market tanked for days. What does this mean? The government is facing a cash shortage and struggles to repay debts on time. Their solutions? First, they could boost revenue, say, by raising tariffs. But that's not immediate, and the results are uncertain. The fastest way to cut spending is to lower interest rates. If rates drop, the government's debt burden shrinks instantly. But here's the catch. Even with today's high rates, few are willing to lend to the government. If rates are cut, who'd still buy U.S. bonds? That's why the Federal Reserve keeps stressing they can't lower rates now. In the past, cutting rates was a quick fix to reduce spending, but now that remedy has lost its potency, like a drug overused until it stops working. The first time you're sick, one pill cures you. The second time you need 3. By the 10th time, even 100 pills won't help, because your body's resistant. So, there's only one option left. The Fed must expand its balance sheet, print more money, and lend it to the government to spend. When that happens, the dollar loses value, and the government's real debt shrinks. For example, if I owe you $100 but money printing doubles the money supply, that $100 is now worth $50. So I only need to repay $50 in real value. But if the government keeps borrowing $100 and repaying $50, who'd still lend to them? When no one buys U.S. bonds anymore, the only solution is to keep printing money and borrowing to spend. That's when the dollar would truly become worthless. Here's the crux. Buffett has issued an unprecedented warning to the U.S. government. But he's not calling for immediate rate cuts or money printing. Instead, he wants them to find buyers for U.S. bonds first before considering rate cuts or injecting cash into the economy. How do you attract bond buyers? Simple. Make the U.S. stock market drop. When the economy thrives, companies profit, and investors pour money into stocks for returns. But if the economy weakens, stocks become riskier, and investors shift to safer assets like U.S. bonds. In other words, U.S. stocks and bonds work like a seesaw. When stocks fall, money flows into bonds. Right now, as the world's strongest economy, global capital mostly flows into U.S. stocks. But if the stock market crashes, investors will seek safety in bonds. How much money needs to flow into bonds? Government needs to borrow $2 trillion more each year. That means at least $2 trillion must be pulled from the stock market to fill this gap. But if that much money is withdrawn, will the stock market collapse? If it does, Buffett, holding a massive stash of U.S. bonds, stands to profit hugely. As people rush to buy bonds, their value would soar. Buffett could then sell his bonds at peak prices and use the proceeds to scoop up high-quality stocks dumped in the market panic. Once enough buyers are secured for bonds, and the stock market tanks, the Fed would have a legitimate reason to expand its balance sheet and print money to rescue the stock market. That freshly printed money could flow through banks, push rates near zero, and let big players like Buffett borrow cheaply to buy undervalued stocks, driving the market back up. It happened in 2001, 2008, and 2001, 2008. Why not this year? In short, Buffett can tap 3 money sources. First, when U.S. rates are high, he lends short-term to the government at high rates with near zero risk. Second, when the stock market crashes and bond prices surge, he sells bonds at a premium. Third, when the Fed expands its balance sheet and cuts rates, he borrows cheaply to buy beaten-down stocks, pushing the market up again. How does the government pull money from stocks into bonds? Easy. Economic indicators. Do we need to walk the streets of New York to gauge the economy. No. We look at data. Last year, despite high unemployment and homelessness, U.S. job numbers still met expectations. Who publishes this data? The U.S. government. Now, recent economic indicators, housing, manufacturing, services, PMI, are all sliding. Inflation is rising. Major U.S. firms are laying off workers. And even the government is slashing payrolls. Whether you're a corporate expert or a civil servant, job loss looms large. Unemployment is expected to climb further. As people lose jobs and income, U.S. consumer confidence has hit a 3-year low. What do these numbers say? The government is openly signaling that the economy is shaky and risks recession. The result? U.S. bonds are rebounding and rising in price. But a recession alone won't trigger a stock market crash. It needs a black swan event, like Lehman Brothers collapse in 2008 or COVID-19 in 2020. What could it be this year? I've covered this in other videos, maybe an AI bubble or commercial real estate crisis. But these are just triggers for market panic. The root cause is forcing money from stocks into bonds. Many still believe holding U.S. stocks long-term guarantees profit. Buffett himself often recommends index funds like SPY, QQQ, or VOO, right? Yet last year, he sold all his SPY and VOO holdings, pulling everything into cash. What does that mean? Even the Oracle of Omaha sees danger ahead. When a train's barreling toward you, you step aside. This shows investing isn't just buy and hold forever. It's about timing and trends. Economies move in cycles. Imagine a stock that doubles in 5 years with no risk. But if it plunges for the first 4 years, would you hold? If it keeps dropping in year 5, would you sell? If you sell, and it doubles in year 6, what then? You've wasted 5 years, and your money's lost value. You saw other opportunities, but couldn't act, because selling meant a loss. That's what happened with Alibaba. China's top stock dropped for 5 years, only recently recovering to a third of its peak. So, timing and trends matter. That's why we've been using guerrilla tactics lately. We're nimbler than Buffett. He plans years ahead. We stay 1 second ahead of the market, profiting and exiting fast. During the recent U.S. stock dip, we didn't lose a dime. Think about this. If a stock has a 99% chance of failure, would you invest? Most say no. But why not ask how much do you lose if it fails? And how much do you gain if it wins? Suppose I invest in 100 stocks. 99 lose $10,000 each, costing $990, but one wins $10 million. I'd still net over $9 million. That $990,000 loss is just an investment cost. Winning odds matter, but so does the risk-reward ratio. In his shareholder letter, Buffett made it clear. His strategy centers on the U.S. with one key exception: his growing Japan investments. In other words, he's draining the U.S. with one hand while reaching into Japan with the other. What does that mean? As I've mentioned, when Japan had ultra-low rates, Buffett issued bonds there to borrow cheaply, then used that money to acquire 5 major Japanese trading firms, turning Japanese workers into his profit machine. In this letter, "Why are these investments nearly lossless?" he said. "Greg has met with them multiple times, and I regularly track their progress. All 5 companies will raise dividends at the right time and repurchase shares when conditions align." What does this mean? Buffett is now the biggest shareholder in these 5 Japanese giants. They're working to make him money. He sends Greg, his successor, to meet their leaders, while he oversees from afar. Even after he's gone, he can still influence their decisions. so these firms won't easily fail. Crucially, they've pledged to raise dividends when appropriate and buy back shares when conditions are right. Raising dividends when appropriate means what? Data shows these firms have steadily increased dividends yearly. Buffett's dividend income from them now exceeds Japan's zero bond rates. He collects yen dividends while repaying yen debts, pure profit. Repurchasing shares when conditions align means when stock prices drop, they'll use company funds to buy back shares, preventing deep declines. It's like an anti-loss guarantee. When prices fall, buyers step in to prop them up. That's why these 5 firm stocks have surged 8%. Why? If you're an investor or fund manager and see Buffett buy a stock, would you follow? Sure. If you lose, you can say, "Even the legend lost. What could I do?" If you win, it's your triumph. Plus, with these firms committed to buybacks during dips, what's to fear? That's why, as Buffett invested in Japan, foreign funds followed, pouring cash into Japanese stocks. But who really profits? Japan's market is largely driven by foreign buyers. When prices rise, profits mostly flow overseas, not to Japanese locals. If these funds hadn't jumped in, prices wouldn't have risen. So how does Buffett still profit? 2 ways: dividends and yen appreciation. Over the past few years, as the US hiked rates and Japan cut them, people borrowed yen cheaply, sold it for dollars, and parked it in US banks for higher returns, tanking the yen. Last year, Japan raised rates, reversing the flow. Money moved from the US to Japan, and the yen jumped 15%. Even if Buffett's Japanese stocks didn't rise, he could sell them, convert yen to dollars, and pocket a 15% gain. And this is just the start. As I've said, if US stocks crash and Japan keeps raising rates, massive capital will flee the US for Japan even faster. Will Japan's stock market soar? Hard to say, but the yen will likely keep climbing. Buffett could use his Japanese stocks as collateral to borrow appreciating yen, convert it to depreciating dollars, and buy US stocks at their lows. His strategy is simple. When the dollar was strong and the yen weak, he borrowed in Japan to buy businesses, collecting Japanese profits and building capital. When US stocks and the dollar tank, he'll use a strong yen to buy weak dollars and scoop up US stocks. He plays the seesaw. When one market rises, he shifts to the weaker one. When it falls, he buys back in. His profits are real because he doesn't just buy stocks. He buys companies, negotiating dividends and controlling outcomes. Critics bash Buffett, but think, if US stocks and the dollar crash, who wins big? That's why, since last year, we've shifted some assets from dollars to yen, gold, and Bitcoin as hedges. For US stocks, we use guerrilla trades, short-term moves. Our strategy mirrors Buffett's hoard capital and wait. As US stocks adjust now, we're awaiting the next trend. Will it crash as pessimists predict, or just dip and rebound? Either way, our plan holds. We'll use profits from other markets to reinvest in US stocks. For Buffett, the US market is the main battlefield. For us too, but when a train's bearing down, we step off the tracks to preserve capital first. Buffett's a titan. We're small fry. Our methods differ, but the core strategy aligns. Will events unfold as we've reasoned? How will we tweak our approach soon? Time's short, so we'll stop here. I share free insights on becoming wealthy, entrepreneurial, and investment savvy for financial freedom. Don't miss out. Subscribe, hit the bell, and share this video to everyone who likes it. I wish you financial freedom soon. If you find just 1 or 2 useful nuggets here to improve your life, I'm fulfilled.